Since early 2009, we have seen the stock markets more than triple. And so today, there's lots of concern out there. Are we in for a stock market bubble? What's with all the volatility? Well, people are concerned, and validly so. Anytime you see something triple in a 6-year period of time, it raises concerns. People have memories that reflect back on 2000, when we had our last major stock market bubble. Well, things are different today than they were in 2000. Back in 2000, if you took a look at the Standard & Poor's 500 index and took a look at the earnings of those companies that made up the S&P 500 index, the price-earnings ratio, meaning the price of the stocks as compared to their earnings, were 30 times their earnings. Some more than 30. Well, if you look at historic averages over the last 60 years, that 30 to 31 times earnings was about twice the historic average, which was right around 16 times earnings. So back then, we did have a stock market bubble. But I must tell you that today, it's a little different. If you take a look at the Standard & Poor's 500 index today, and you take a look at the price-earnings ratios of those 500 companies, what you'll find today is that the price-earnings ratios are somewhere between 17 and 18 times the anticipated 2015 earnings of those corporations. That's slightly ahead of the 60-year average of 16 times earnings. A far cry from what I would call a market bubble. And so while we may have market volatility, what I can share with you is that in my professional opinion, there is very little likelihood that we will have a market crash like we had back in 2000 to 2002. Now, another measurement of market volatility is what happens during a calendar year. How far up do the markets go and how far down do they go? Well, there was a study done that went back all the way to 1946 and took a look at the last 68 years of the stock market. And what they found was that if they took a look at the calendar years individually, and if they took a look at the low point in any given year and averaged it out, over the past 68 years, markets have been down sometime during the year, on average, about 14%. That's pretty scary. However, the good news is that by the end of the calendar year, those same stock markets over those 68 years, on average, were up. In fact, they were up over 70% of the time. And so while market volatility is something that causes our nerves to jitter us and causes us to be a little uncomfortable, quite candidly, market volatility is good. In my opinion, it's the oxygen that fuels the next rise in the markets over the long haul. But keep in mind, be a patient investor and view your investments as long-term, because if you have enough liquidity, you can ride through the storms and weather those storms and let your long-term investments do what they do best. Because markets do drop temporarily, but in the end, they go up higher and higher. Thank you.